Now that the dust has settled on 2021 and it is now firmly ensconced in our rearview mirror, I thought it would be worth just having a quick look back at the year in review, and just to see if there's anything of interest that wasn't immediately apparent at the time. So what I've done with this year in review is it's broken into a few very, very loose segments. I want to look at indices in a very, very broad sense. Look at the structure of those indices and why they might be doing what they do. Look at commodities and then sort of bookend it with a very, very quick look at Bitcoin. Now, in terms of indices, what I've done here is I've broken this into a series of very broad geographical segments. And as you can see, the standout once again in terms of geography is the US. And within the US, what is interesting is the performance of the S&P 500, which for the past year was extremely strong, even outpacing the Nasdaq, which is a little bit surprising. When we look at these in terms of a relative comparison over the past year, you get a sense that, to a degree, they largely track together with the exception of the much broader Russell 2000. And that is often the way. Broader indices, because they comprise a much greater data set, tend to often be laggards, particularly when compared to these very narrow focused indices, particularly one like the Nasdaq. But time frame is everything in these relative comparisons. And whilst this gives us a little bit of information about the short term, and it certainly tells us a great deal about the extreme performance of the S&P 500, if we blow out the time frame a little bit further and we take it out to 2017, what becomes apparent and what remains apparent are two things. One, the persistent outperformance within this segment of the Nasdaq 100, and the persistent underperformance compared to its peers of the Russell 2000. And dropped in the centre there is the S&P 500 and the Dow. And you can see that there is a shifting in terms of performance ranking over this period between the S&P 500 and the Dow. They tend to oscillate, but the performance differential generally has not been that great up until this year, where there had been a widening. But again, we need to be careful because all of these relative comparisons are dependent upon starting date. So when you see relative comparisons placed out there telling you that one thing is doing better than another, pay very, very close attention to the starting dates, because small alterations in the starting date can result in very, very large differences in terminal performance. And I often see this in LinkedIn when I get people pushing a particular market segment or a particular investment idea. They pick time frames that suit their investment vehicle, so that when you go back and you look at a slightly different time frame, you get a very different picture. These are worthwhile. It's not that they do not have value. But again, like all things, we have to be aware of the preconditions that we've put in place before we begin the exercise, because everything is dependent upon our assumptions. What is interesting about the S&P 500 is the number of index all-time highs that this particular market made during the last year. And this is a chart from isabelnet.com, a site well worth going to. Once a day or so, they post some very, very interesting charts. And last year, the S&P 500 had the second most new highs ever. And you can see it is somewhat of an outlier compared to the previous 5 or 6 years. But one of the things about the S&P 500 is because of its construction, it generates consistent performance. What I've done here is I've looked at the S&P 500 and its yearly returns going back to 1950. One thing's immediately apparent. There are not that many down years. Yes, come 2008, time of the GFC, that's a substantial drawdown in the index. Most of the other drawdowns are quite modest, even post the tech wreck, even post the bear market of 73, 74. The other thing you'll note is that there is a large number of these years express double-digit gains. When you look at this sort of thing, you can understand why for very mediocre fund managers that they struggle to match the long-term performance of the index, and why people have a tendency to move into EFTs. Because EFTs generate a performance that is equal, or let's say equivalent, net of fees to the index itself. Something that most managers struggle to match, because most managers struggle to generate alpha, that is, an outperformance over the index. The construction of indices like the S&P 500, where rubbish stocks are dropped and new ones are brought in, mean that you need a very, very active engagement to try and beat this market. But one of the things I want to talk about, one of the themes that I want to stress in this little presentation is the notion of simplicity. When looking at the US markets, I also looked at a simple metric of best performing shares for that year. This is Destination Excel. This is a Nasdaq stock. Its low point close to high point close generated a return during the year of 2,921% if you had fluked that particular segment of the move. But there's one thing I want to sort of draw people's attention to. What you'll see here are three boxes. These are effectively what you would call a very lazy Davis box. It's simply a bracketing of price within a broad range of congestion. The trading technique for these is quite simple. When price breaks out of congestion under volume, that's a signal to go long. And you'll see this stepwise pattern in a large number of shares. The other thing that should be apparent is there's no indicators on this chart. I've not plastered it with gibberish in an attempt to somehow remove the opacity of the market. Breakouts tell you something very clear, and what they tell you is that there has been a change in sentiment and a change in control. You move from a point in congestion where neither bull nor bear is in charge. Once price breaks out of that, you're actually being told something. You don't need a raft of indicators to tell you that. You just need an understanding that you can look at a chart, draw a straight line across it, and take your signal from there. But if we pop back to this notion of comparing indices, what I've done is simply taken that table from the first slide and graphed them. And I've highlighted our market in purple. You can see we're sort of middle of the pack. We're certainly not rubbish like the Hang Seng. The performance of the Hang Seng is to be expected because you've moved from a situation where a financial centre was governed by the rule of law to one which is now governed by decree. It's difficult to understand how investors could have anything other than a negative response to that. What is interesting, though, is the performance of the Euro Stoxx 50. But when I first graphed these, that came as a surprise to me because I'd not been consciously aware of its performance relative to other indices during the year. And what is good about our index is it was actually a positive return. However, simply broadly looking at the performance of an index in comparison to others can be a little bit deceptive, because the S&P or the ASX 200 is a narrow, broad index, and it doesn't in many ways give a sense of the opportunities that occur within markets. So what I did was I went and looked at the top 20 best performing stocks in our market. And you'll notice that there are some extraordinary performances in here. And I went through the All Ordinaries, and I went through and I looked at it with the notion of trying to find out what sort of bracketing of performance there was. Now, the way to read this chart is left-hand axis, you see greater than 25%, greater than 50%, greater than 100%. You see 3 bars. At the end of each bar is a number. The way to read this is that in the All Ordinaries, which is 500 stocks, give or take, on any given day, 167 of those stocks had an annual return, which is probably not the right expression, but a price change of greater than 25%. 87 had a price change of greater than 50%, and 33 greater than 100%. This highlights a very, very important point that is often missed, because one of the things I'm often confronted with is emails from people going, I must trade the US market because it's the only market that offers opportunities. That's simply not true. There are always opportunities. When you have a market that is trending up, there are always opportunities. And it's important to note that, because the moment you frame an investment decision or discussion with the phrase, I must trade this market because, you've instantly removed any idea that you will look elsewhere for opportunities. And it is at that point that you make the mistake of ablating a large segment of potentially profitable opportunities to you. And it is always an error. There are always opportunities. And they're always comprised of simplicity. If we look at our local market, the other thing I'll say is that you'll notice that this chart and the Dimension Excel are freely generated charts. There's nothing special about them. So there's no need really for immensely complex pieces of software. This is Lake Resources, one of our better performing stocks of last year, and you can see the same approach. A series of these boxes with breakouts. So again, simplicity rules. And if you want an extreme example over time of this sort of thing, this is Chalice. Chalice has had extraordinary performance beginning in 2020. But prior to that first breakout you see, this stock had gone sideways for years, highlighting a very, very important rule. The longer a stock goes sideways, the more explosive the move out of that congestion will be. And you can see here that Chalice generated what's known as, colloquially, for some people it was a 10 bag, for some 15. That means they got a 15 times return on their initial investment. Which brings me to an overarching lesson and something I repeat ad infinitum. Simplicity works and complexity is bullshit. What I tend to find with people who present complex trading systems to me is they have done that not for the purposes of perhaps increasing the fidelity of the decision making, but rather it's an ego-based decision. I have an immensely complex trading system. I'm the only person that can understand it. Therefore, I am smarter than everybody else. The problem with that is that it lacks robustness. Complexity, by and large, is very fragile and very, very much prone to breaking down. Simplicity works, but the problem with simplicity is it requires the confidence to accept your own judgment, not to try and defer that judgment to a series of indicators that you hope will remove the veil of tomorrow, next week, next month from price action. And what is forgotten in all technical analysis is that all indicators are iterations of price. That's it. They don't do anything else. They do not magically pull future prices out of the ether and then plug them in. They all look at the same thing. They all look at the past and attempt to manipulate that data in some way to present a different coloured line that you might find attractive. What is also interesting is that in an era now of cryptocurrencies and NFTs and the like, which I'll have a bit to say about in a moment, people tend to forget the raw power of equities, particularly here in Australia, where we have a market that is in many ways leaning towards the more speculative. It is not unusual in Australia to have a mining stock that explodes from 10 cents and goes to $14. A recent example of a similar breakout is Vulcan. These are extraordinary returns, but because their equities are regarded as boring, they're often missed by traders. Because traders, by and large, are a little bit like cats with a laser pointer. They will go wherever the laser is pointing. They're not very self-directed, so they tend to respond to the whims of the crowd. In terms of commodities, commodities had, by and large, as a group, as a very heterogeneous group, a very good year other than the precious metals. You can see that many of the softs had extraordinary performance. The energy sector as a sector was very, very strong. But looking down the bottom, we see that precious metals were actually very, very poor. Part of my thoughts regarding gold revolve around the fact that what we might be seeing is a generational shift. And what that generational shift means is that newer generations of investors and traders do not look to things like gold as perhaps, let's say, a hedge against inflation. Now, spoiler alert, it's not. Second spoiler alert, apparently classic Legos have found to be a better investment over the long term than gold. But whenever gold hiccups, my LinkedIn feed lights up with people who are religiously linked to gold. And by religiously linked, I mean they have a belief system. And their belief system is that gold is the only thing, and the moment it does something, you must go all a Twitter on it. Once you have that sort of belief system, you're not making rational decisions. For example, last year in commodities trading, the place to be was the energy sector and the softs. It was not precious metals. They were incredibly poorly behaved. And you can see this when we look at these as segments. So this is the energy complex. And you can see they all did well. You can see the very large spike in natural gas during the year. Another point to note about these returns is they look at year beginning, year end. So in some ways, the point you see at the end, the data you see at the end, is not reflective of the journey. For example, if we look at natural gas, you can see a breakout from a base formation at around 3, running close to 7. So your rate of return during the year is, as a trader, greater than what you would see if you simply bookended the year and said, well, it started the year here, finished the year here. For traders, trajectory is everything. And you can see the variance in trajectory when we throw a few of the softs into the mix. And the one I want to concentrate on is corn, because corn once again also gives us an indication of simplicity. All we have is a break from congestion. That's it. It's very boring, it's very, very dull, but that's all that is actually required. And so this brings me to the sort of reaffirmation of this point. Simplicity works across markets. I instantly lose interest with people who begin to sprout off that each market requires a different trading system. No, it doesn't. It simply needs one, and that one needs to be simple and robust, and to recognise that price is everything. Anything else is merely it's a comfort tool. It's a crutch that we use. So to round this off, this is Bitcoin, which generated a return last year, bookending from year close to year opening to year close, about 52%. Hardly spectacular. There were trading opportunities in between. And again, this is one of those things where we have to separate the utility of a vehicle as an instrument from trading versus any perceived financial utility the marketing says it has. Cryptocurrencies fall into the former, in that they offer trading utility because they move. But the thing to note about Bitcoin is something like 87 or 88 stocks in the All Ordinaries last year did better than Bitcoin. Lake Resources had a 20 times return compared to Bitcoin. And this is the issue. For everything there is a season. All investment generations go through almost this rite of passage. When I first began trading, we moved from speculative gold stocks to biotechnology stocks. They were the flavour of the month, pre-1987. We then went through 87 and the fallout from that, and in the late 90s we ran into the tech boom. Lessons for another generation. When we moved into pre-GFC, we ran straight into financial instruments. Now we have cryptos. Every generation has something. And we need to be cognizant of that. One of the problems that people face is they're simply not students of history. They're not students of the market. They think that everything they see and experience is unique. The analogy I would use is that every teenager who has sex in the back of their car thinks they invented it. People have been having sex on the back of things since we had things to have sex on. There is nothing new, but we think there is. And we forget that these things come and go. But if we are religiously wedded to them, for example, members of my trading generation are religiously wedded to gold. They cannot let it go. And as I mentioned before, the moment gold moves slightly, I get these prognostications saying this is it, gold's going to $5,000. Inflation's coming, no, make it $10,000. No, that's not happening. Gold went up 0.1% last night. That's it. And it's continued to go down throughout the year. So my generation is wedded to that religiously. And it is a religious belief because it cannot be shaken. And in many ways, members of this current generation are wedded religiously to Bitcoin. You merely have to look at some of the gibberish that's posted on Twitter with prognostications that Bitcoin is going to $1 million. Certainly didn't look like that last year. It does not remove its utility as a trading instrument. But what it does speak to is this wider notion of being wedded to things. Trading is a profession of fluidity. It is a profession whereby you are continually in motion. And that need to be continually in motion and not wedded to things is often problematic for people who are prone to dogmatic points of view. But what this sort of harks back to is this notion there is nothing new. All investment generations suffer the same malady because humans are humans, irrespective of what generation they belong to. Which in closing brings me to 2022. What was interesting about the transition from 2020 to 2021 was this notion that somehow the flipping of a date on our calendar would somehow make things different. Well, COVID simply said, here, hold my beer, watch this. So regards to 2022 and markets, and many of these reviews that I've seen and many of the stuff I get sent begin to make prognostications about what to watch for, what might happen, what they think's going to happen, key points in the market. The only advice I can offer people is that in 2022, some markets will go up, some markets will go down, some markets will go nowhere. And what your job as a trader is to be long those markets that are going up, short those markets that are going down, and not stuck in those markets that are going nowhere.